Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Now, this is very unusual to see sequential declines in money.
As the dawn of 2025 approaches, Cathie Wood issues a stark warning about monetary policy's inadequacy, highlighting a sense of urgency for the challenges ahead.
Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one, but most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. Monetary policy, well, let's just look at the numbers first. M2 growth peaked at 27% in 2020 and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely.
In a striking observation, Wood notes that a majority of people in the United States remain oblivious to the far-reaching ramifications, raising concerns about collective financial unawareness.
If you look at M2 also, you'll see that it actually peaked in March. Now, this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different, it's such a low base. That's the whole point, it's a low base, 13 times. So if they raise the Fed funds rate another 75 basis points, this will be a 16-fold increase compared to Volcker's 2-fold increase.
Turning her critical gaze to the Federal Reserve, Wood asserts that its present state is not just ineffective, but has devolved into something worse, prompting contemplation on the efficacy of current economic strategies.
Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And so Chairman Volcker did choke off money supply and inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked, as it did in 1981, until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job.
Wood reveals that the United States has been wrestling with inflation for a considerable period, challenging conventional narratives and forcing a reevaluation of the nation's economic health.
Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. today we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a two-fold increase.
The narrative takes a cautionary turn as Wood admonishes against the prevalent trend of people opting for shortcuts to achieve their goals, prompting reflections on the sustainability of such approaches.
Many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited.
Debunking the notion of a short-lived crisis, Wood makes it clear that the inflationary challenge is a protracted 15-year ordeal, setting the stage for a prolonged economic struggle that demands careful consideration.
There is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match one for one the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view. But they don't. And with banks, and a very low interest rate environment, they got used to using derivatives and taking shortcuts to try and accomplish the same goal.
Expressing skepticism about current policies, Wood suggests that the Federal Reserve might be making critical mistakes, injecting an air of uncertainty into the economic landscape.
So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd.
The narrative shifts to corporate struggles, as Wood highlights the alarming trend of many companies experiencing negative revenue growth, underscoring challenges faced by businesses in navigating the current economic terrain.
I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. And reflecting a little bit more on the Jackson Hole speech that Chairman Powell gave in late August, we've come to recognize that Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo, and the stimulus that came about because of it, both monetary and fiscal policy, we never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now.
Unexpected shifts come to the fore, as Wood notes that no one foresaw a sharp increase in interest rates, introducing an element of unpredictability, challenging preconceived notions about the trajectory of financial landscapes.
For some time now, we've been saying that the Fed has overdone it and that the greater risk here is deflation. Yes, the CPI did not surprise us at all, although there were rumors that revisions would take it higher than many people thought. And so we believe we're beginning to see deflationary trends in many more sectors now. It started with commodities. Now we're seeing airline prices coming down, auto prices coming down. And we're seeing staples prices. They have been sticky, but what's happened to staples volumes? They have gone down. That's not how you run manufacturing plants. So we think that they will be forced into cutting prices as well. You heard Home Depot today, negative 3.8% comp store sales here in the United States. And if you look at the S&P 500, I think a third of all companies in the S&P 500 are reporting negative revenue growth. What we have characterized the last 2 years as a rolling recession. Some measures of housing are down 40%. That's a recession. Autos, 15 million units in the U.S., that's kind of punk. It's recession-like. And we're seeing these volume declines in staples. Right. You've got consumers pulling back. So I think the Fed's overdone it. I think we're going to see a lot more deflation going forward. We are going to hit that 2 handle, and we will go below it, and would not be surprised to see CPI inflation negative at some point next year.
After a very long period of very low interest rates, I heard someone say the other day, and we were talking about this LDI crisis in the UK, that the reason it's so serious is pension fund sponsors were beginning to think, and banks were beginning to think, that interest rates would stay very low for a very long time, for as far as the eye could see. And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case, for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops, no matter what.
The narrative reaches its climax as Wood expresses deep concern about the potential harm that current policies could inflict on the system, inviting contemplation on the broader systemic impacts of economic decisions, raising questions about the road ahead.
While the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, this was going to cause a great deal of harm to its system, and so it had to reverse its policy. So this is another reversal in policy, or it's a bit of a shift in policy. It's an outright easing, and they said they will continue until October 15th. So now all of these pension funds, in collaboration with the banks, are deleveraging, and they have till October 14th. So what do you do is if you're deleveraging in an illiquid environment? All markets are experiencing duress today. I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. And so we're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. And so we think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation.
Well, actually, Tesla is one of the most profound AI companies out there. And that is why it is at the top of ARKK, ARKQ.
With a razor-sharp mind and fearless approach to investing, Cathie's made a name for herself by backing some of the most innovative and game-changing companies of our time.
The fact that Bitcoin moved in a very different way from the equity markets in particular.
While others might be content playing it safe, Cathie's made a career out of taking calculated risks, backing new technologies and industries that might have the potential to change the world.
Well, I do believe that the stock market, has been discounting this for a good part of this year. The market is in a bear market. So the equity market's not going to be surprised, and even the fixed income market's not going to be surprised. The yield curve, so the difference between the 2-year and the 10-year Treasury yield, is over 80 basis points, 0.8%.
Her investment philosophy is simple. Find disruptive companies that have the potential to change the world and hold on to them for the long term.
If you look at the blockchains, let's use the Bitcoin blockchain and Ethereum, what you'll find is they have the infrastructure, the technology has not skipped a beat throughout this entire crisis.
In a recent interview, Wood warned that a certain event could trigger a major market correction, one that could impact everyone from individual investors to big institutions. While she didn't go into specifics about what that event might be, she did note that it could happen sooner than anybody would think.
I do believe that the surprises now are going to be on the low side of inflation expectations, dramatically so. We believe that inflation will drop below the Fed's 2% inflation rate sometime next year. And the pipeline is telling us that. Commodity prices, inventories, which are overwhelming and causing all kinds of discounts.
This warning comes on the heels of a period of unprecedented growth in the market, and with many investors seeing double-digit returns over the past year.
I'm struck that the market is now leading the Fed. And when I say the market, I'm really talking about the bond market. So the 10-year bond yield peaked in October at about 4.3%, and is now down this morning, I think, to 3.35%. The hash rate, Bitcoin's hash rate, is at an all-time high, and that is a real indication of the security of the network. On Ethereum, we're seeing the total value staked at $24 billion. That is an all-time high. I think the bond market is suggesting that is so. Yes, we've seen the deflation in the pipeline, as Julie mentioned. It started with commodities, And then during the holidays, we saw massive discounts. We've seen used car prices, I think they're down 14% year over year, having peaked at up 55% year over year.
Since the collapse of Silicon Valley Bank, the market has changed its Fed expectations for a less hawkish or a more dovish Fed. You cite the Fed as the cause. How nimble are ARK being? How much are you recalculating your view going forward?
Well, as we said before COVID, as we were descending into that, and we are saying now, innovation solves problems. And you showed a few charts at the beginning that suggest that some of the innovators out there are solving problems. I mean, I think the most dramatic example of it to us was the behavior of Bitcoin last week. It absolutely took off. It was a flight to safety vehicle. And so it is really proof of concept that innovation solves problems. There are, in Bitcoin, fully decentralized, fully transparent, auditable, which is addressing all of the banking's problems right now. And so a flight to safety, a little bit of an insurance policy. There's no central point of failure in Bitcoin.
Do you worry at all about, as you buy into Grayscale, Cathie, the whole world of the digital currency group and Barry Silbert's company? I mean, the various connections that kind of go back to FTX. Are you at all worried about a liquidation or anything?
Well, we know that the Grayscale investment trusts are the most valuable part of that company right now. And they are they're cash cows. They're revenue generating. We do not think, we think they're going to try and hold on to that, if nothing else. We're looking at a 41% discount of this trust relative to Bitcoin today. And so we actually think there's a lot of upside. Now, one of the things that we know that Grayscale and Michael Sonnenschein at Grayscale wanted was to convert this trust into an ETF.
Right.
I think what's happened with the fallout here might increase the probability that a Bitcoin ETF will be approved. I'm not saying immediately, but we know that, and even the newest SEC commissioner, Jaime Lizarraga, I think is his name, has come out and said, we need as regulators to focus on decentralization and transparency. What is the most decentralized and transparent crypto asset in the world? It is Bitcoin. And yet retail investors do not have easy access through a liquid asset like an ETF, which honestly, I don't understand, given that they approved a Bitcoin futures fund. So, I think it might increase the odds. We shall see.
Cathie, we know you're a long-term investor with long-term calls, but what on earth gets us to that bull case of almost $1.5 million per Bitcoin if a bank crisis doesn't?
One of the things that happens in a crisis is liquidity dries up. So that tends to hurt assets. And the fact that Bitcoin moved in a very different way from the equity markets in particular was quite instructive. You'll find the building blocks of those price targets in our Big Ideas 2023. So ARK Big Ideas 2023, and they are, for the base case, I would suggest quite conservative. We've dialed some of them down since last year. I know that corporate treasuries pulled away from Bitcoin because the regulators were pulling them away from Bitcoin on their balance sheet. So we've pulled back there. But we do believe that the behavior of the price through this crisis is going to attract more institutions, for example. We've done a report targeting institutional investors and the allocation that they should make if they care about this new asset class diversifying their portfolios. And I believe it's somewhere between 2.5% and 6.5%. So not crazy. These are the sorts of allocations they would have made to emerging new categories of assets like real estate in the 70s, emerging markets and small cap in the 80s and 90s.
Well, and some have been wondering whether or not you're playing the arbitrage with GBTC right now. You know, is it that because of the trust deep discount at this point? Is that the thinking for you to kind of be moving more money into this name?
Well, it is one of the few securities. We have to own securities in ETFs. So it is one of the few securities we can buy. And yes, it's at a very big discount. So it is more attractive. Bitcoin, if they were to even liquidate it, you know, we've got such a big discount relative to Bitcoin that, again, we don't think they're going to. This is the most valuable property. I think they're going to hang on to it. And I think over time the discount will close. Don't know if it's because of a conversion to a Bitcoin ETF. I'm sure the regulators will take a very close look at DCG and the Grayscale Bitcoin Investment Trust. But we do know this is a grantor trust, highly regulated. I mean, we had to do our homework on it. And we know that all of the Bitcoin behind GBTC is in cold storage at Coinbase, and Coinbase has confirmed this. So, we feel quite comfortable with it here.
You say ARK is the new NASDAQ. Tell us what's behind this big move in terms of growth year to date. And do you think it's sustainable?
Well, I think the biggest reason is interest rates coming down, inflation coming down, because the terrible performance in growth and innovation-based strategies over the last 18 months had been a function of expectations that interest rates and inflation would continue to rise and that we were stuck in a 70s-style inflation. We are not. I think the bond market is beginning to lead the Fed. And yes, I do think we're not going to go straight up, of course. We don't want to go straight up. We want this to be much more deliberative in terms of investing. So yes. And new NASDAQ, this is an expression we've been using. We were trying to communicate last year, hey, our portfolios do not include the stocks in the NASDAQ for the most part, except for Tesla, perhaps. The world is changing incredibly quickly here. And we're seeing this with AI, of course, all of the news around ChatGPT that's captured the public's imagination, captured business imagination. It's happening very quickly. And our portfolios are very focused on the future. The NASDAQ and other broad-based benchmarks are much more traditional. They are really the names at the top of those portfolios are the companies that have really done incredibly well over the years. But we think many of them will be disrupted. And we're seeing already questions about Google and search and could Microsoft Bing disrupt Google? This was the former disruptor when it came to advertising and media.
But I do want to start with Tesla. Your reaction to those results we did get yesterday, and specifically the fact that the operating margin dropped pretty dramatically to 11.4%, certainly in focus for trading today. Does this change your outlook or your thesis around Tesla?
Not at all. In fact, curiously, we want Tesla to scale its units because each one of them now represents the potential for a robotaxi and a robotaxi fleet. Now, Elon says it's possible that he could launch that fleet this year. We think it's more like last year. But the robotaxi fleet is really going to be, or the robotaxi service is going to be, from a margin point of view, more like a SaaS business. And so we think that it's very smart to maximize units because they have so much option value now.
a lot of these names have gained year to date, but they had a horrible year last year, Tesla included. Would you be poised to lessen exposure to Tesla as you increase exposure to AI, chat, GPT plays?
Well, actually, Tesla is one of the most profound AI companies out there. And that is why it is at the top of ARKK, ARKQ, ARKW has a big position in it as well. It is not an auto company. It is a technology company. And autonomous taxi platforms, we believe, are the biggest opportunity in the next 5 to 10 years out there around artificial intelligence. So just to give you a sense of that, Tesla right now, its gross margins are in the 25% range. That's electric vehicles. We think they're going up from there. But autonomous is a SaaS model. Those autonomous taxi platforms, and we think Tesla's in the pole position to be the platform, the primary platform in the United States, those gross margins will be in the 80% range. So we believe that so our target price for Tesla, at least the published one right now, is in the $1,500 to $1,600 range. Wow. From roughly $200 today in the next 5 years. We have a 5-year investment time horizon. And we believe that a third of that, roughly, will come just from the electric vehicle scaling. I mean, we're in the sweet spot of the S-curve for EVs now. The rest of it will come from AI. And we think, those looking for killer apps, that's probably the biggest killer app out there globally.
We've been hearing about the robotaxi fleet for some time. There's a lot of regulatory barriers to all of that, and certainly technological barriers involved too. So how soon can we actually see that realized? And given the fact that you tweeted earlier today that you've got a new valuation assessment of Tesla coming out, how does that fit into your price target for the stock going forward?
The price target for our stock, and I think it's just hitting now, for 2027, because we do have a 5-year investment time horizon, is our expected value is roughly $2,000, and that's within a range of $1,400 to $2,500, our bear and bull case. Now, just Morgan, on the regulatory side, I actually think regulations are working in Tesla's favor. For, I think, roughly 3 decades, the number of auto fatalities in the United States fell to the low 30,000 range per year. And they've turned around in the last 5 years and moved up to 45,000 plus. And I think the pressure is on the National Highway and Transportation Safety Association to change something. So it is looking carefully at Tesla's data. And during Investor Day, Tesla released some data that we don't think many people paid enough attention to. The most important one is that with full self-driving, a Tesla vehicle gets into an accident every 3.2 million miles. And that compares to 1 every 500,000 miles for the average car on the road.